Okay, you guys, so let's go ahead and get started with growth stocks first because really that's just honestly, that's my personal preference. So I want to go ahead and start with growth stocks. Now, exactly how do growth stocks work? So growth stocks work like this. So growth stocks are individual stocks that you can invest into. They're publicly traded stocks that you can invest into in the stock market. And then again, they're individual stocks. They're not groups of stocks. They're not, index funds or ETFs or anything like that. They're individual stocks of public companies that you could purchase shares of. Now, what makes these growth stocks? What makes them growth stocks? So what makes a growth stock is that growth stocks, their whole intention and their whole purpose, what they're trying to accomplish is they are specifically in the growth phase as a company. Okay, so what this means is that this company, this type of company that is going to qualify as a growth stock, they're not looking to, take the cash that they are generating or earning in their business to do anything other than pour it back into the company to grow the company at a very fast rate. That is the goal of the company. Now, they're going to do this in multiple different ways. They're going to do this through reinvesting back into creating better and more additional products. They're going to, reinvest money that they're earning in the business back into research and development. They're going to, spend some of this money on, maybe partnering with other companies to expand and grow the business. They're going to do just about any and all things that is available to them, and they're not going to spare any resource that they need to use in order to grow the company and just, expand the company to get it to become a much bigger, larger scaled company. This is exactly what growth companies do. Now, it doesn't only stop there. What ends up happening as a result is, like I said, the company does not want to use its cash for any other purpose other than growing the company. So what this means is that in most growth companies, they're not going to pay a dividend. And in case you're just completely new and you do not even know what a dividend is a cash payment out on a per share basis. So if you own one share of stock in a dividend company, they're going to pay you a portion of the revenue that the business generates on a quarterly or twice a year or an annual basis. But without getting too caught up on that particular subject, because right now we're not talking about dividend stocks, we're talking about growth stocks. So without getting too hung up on that, what you're going to find is that most growth stocks don't pay a dividend of really any amount. Now, some do occasionally, and it's typically going to be a very small amount of money. But that is not the reason why investors choose to invest into those growth stocks. The real reason why most investors choose to invest into growth stocks is because typically and generally, it's not always the case, but in general, most of the time, growth stocks tend to grow at such a fast rate that the returns that an investor would get from investing into a quality growth stock is going to be significantly higher than the overall general stock market, right? And what do I mean exactly when I say the overall general stock market? Really what I'm referring to is just the index funds that track the S&P 500, because really the S&P 500 is really just a very good indicator of the overall stock market as a whole, because the way that index, the S&P 500 is put together, it represents all the different sectors and industries of the stock market. So as the S&P 500 performs, and whatever that return is, typically it's about 10% annually, so if the overall general market is getting a 10% annual rate of return, so typically a really good growth stock, when you invest into it, is going to generate you, the investor, returns that are significantly larger than the 10% that you would expect through investing into something like an index fund, or in other words, growth stocks are simply just outperforming the market on an annual basis. Now, yes, growth stocks have their ups and they have their downs, but basically when it's all said and done, growth stocks typically are going to outperform the general stock market overall, because the general stock market, again, is going to give you about that 10% annual rate of return. And then really good growth stocks, they're going to give you somewhere between that 20 plus, 30 plus percent per year. It does not mean that every single year is going to be a 20 plus percent, rate of return, but what will happen is even if a growth stock has a down year, when they have those up years, it could be even well beyond, that 20% rate of return. It could be a 50, 60, even 100% rate of return in one single year. So this is the way that growth stocks work. Growth stocks are really companies that are in the growth phase of their business. They're still relatively young companies, and they're not focusing on trying to, reward investors who are investing into the company in the form of cash. They're not trying to make payments out to investors for holding on to their stock. That's not where the financial reward is coming to investors when it comes to investing in growth stocks. Growth stocks are getting the reward of having the stock go up in a higher and higher, price per share. So you might invest into a growth stock at, say, $30 a share. The company's going to start generating, extremely high rates of return. And before you know it, that stock will easily, in 1 to 2 years, could easily be a $100 stock, or, in a 2 years, it's a $100 stock, generating you significant returns. And that is where investors, when they're investing into growth stocks, that's where investors see, significant returns and grow their wealth in an exponential way. Because that's ultimately the goal of, businesses that are growth stocks. And for investors who are investing into growth stocks, what they're looking to, both the business and the investor, is to get exponential returns. All right, so what this means is that if you are an investor and you're looking for a place to go ahead and invest your money, and that you want to go ahead and get exponential growth on your investment, and you want that exponential growth to be larger than the overall general market of a roughly annual 10% rate of return, growth stocks could be a tremendous investment for doing exactly that. But something that I want you to keep in mind and make sure that you are fully aware of is that what this involves is that you have to know exactly the type of company that you are investing into, what that company does specifically, understand exactly how they make their money, what is the goal of the company, what do they sell, who's their customer, are they generating profits and reinvesting back into the business? You don't want to go out there and just invest into any old company that is a growth stock, because you do not want to lose your money. So what I suggest is that, yes, as great as growth stocks can be sure that you take the time, do your proper research, understand the company fully before you go ahead and invest into it. So again, I'm not trying to deter you from investing into growth stocks. Again, growth stocks are actually my preference when it comes to investing into the stock market. Those are the particular type of stocks that I prefer rather than dividend stocks, and we'll get into that in a minute. You just really need to be very careful when you are making investments into individual stocks, and even more into growth stocks, because you are relying on that specific stock to grow. And if you make the wrong type of investment into the wrong type of growth stock, not only is that stock not going to grow, but it's also going to do the opposite, and it's going to go down in value, causing you to lose money. And that's what you don't want, and I don't want that for you as well. So again, if you're going to go ahead and decide, yes, I want that exponential growth, I want to invest my money into a company that is going to be growing at an exponential rate, I want that growth, I want to be an investor into a growth stock, do your proper research, do your due diligence. And once you are fully aware of exactly the type of company you're invested into, you know what to expect, then at that point, yes, go ahead and just fully invest with all your confidence. Now that we got growth stocks out of the way, now let's go ahead and start covering dividend stocks. All right, you guys, so now let's go ahead and dive into dividend stocks. So what exactly is a dividend stock? So without making things complicated or, trying to overwhelm you with all the technicals of a dividend stock, simply plain and put, a dividend stock is an individual stock that you, the investor, makes an investment into. And for every single share that you purchase, that dividend stock or that dividend business is going to pay you, the investor, some part of the revenue that that business generates. And when they pay that to you, it's going to be in a cash payment form. Doesn't mean they're literally going to come to you and hand you cash, but most likely in your brokerage account, the money will get deposited to you and paid out to your investing brokerage account. Now, they do this in many ways. Some dividend stocks make the payment, on a monthly basis. There is those individual stocks. There is dividend companies that pay on a quarterly basis, so that's going to be 4 times a year. Then there's going to be some dividend companies that pay semi-annually, which means they're going to pay twice a year. And then there's some companies that they only make the dividend payment once a year, so that's just annually, right? So those are some of just the examples of exactly what a dividend stock is, and exactly, what a dividend is specifically, and how they go about paying out that dividend to the investors who are investing into their dividend stock. Okay, so why is a dividend stock a dividend stock? Well, it's because they pay you, the investor, a dividend. That is what qualifies a dividend stock to be a dividend stock. Now, this is what you'll generally find when investing into dividend stocks. Dividend stock companies or individual stocks that pay dividends, they generally are companies that are older companies and that are more mature companies. So they've already been in business for a while. They've already grown to most likely a substantial size, or they are just a company has reached a point where they just simply don't know how to grow the business much further than they already are currently at, or they're maybe just in an industry that just does not have a lot of innovation and things like that. So they're really just like in a phase where they're like, hey, how do we attract investors to invest into our company? How do we bring in or draw in investors so that way we could get them to invest into our stock and into our business? So the way that they're going to do that and bring in new investors to invest into their business is going to be through taking some of the revenue that the business generates, and they're going to say, hey, we're going to go ahead and say, if you invest into our stock, we're going to make this dividend cash payment out to you, again, quarterly, monthly, semi-annually, or annually. And that is going to be attractive to the type of investor who's like, I need or I want to be earning income on a regular basis, So if you're someone who's like, oh, I'm good, I have income, I have money, that's not what I need right now. What I really want to do is I want to grow and build my wealth right now. So if you're in the building phase of wealth, then probably a dividend stock is not going to be the thing for you because they're going to be paying you a cash payment. Now, something else to keep in mind when it comes to dividend, stocks is because these companies are like, we're already more mature, or they're not, very innovative or things like that. They tend to be a slower growth company. They're not growing very fast. Sometimes they're massive companies. They're generating tons of money. They're very successful businesses, but they're not growing. So their stock moves very slow, And what does this mean for the investor? It means you are not getting that share price appreciation. So you are not going to be investing into a dividend stock and be like, hey, that's where I'm really going to grow and build my wealth through the price of the stock appreciating over time. You can hold a dividend stock company and it might not double for 5, 6, 7 years, and it still might not, double. It's because that is not what dividend stocks really are about. Dividend stocks are just companies that produce large amounts of revenue. They have a good product, they have a good service. If it's a good dividend stock, they have a good product, they have a good service, they have a good business model. All of that is good, but they're just not in the phase of growth anymore. They've reached a point in their business where now they are just generating revenue, and that really they're not really looking to grow so much more, but what they are really looking to do is just maximize their revenue as much as possible. Yes, they will still grow, but very slowly. Okay, so when it comes to dividend stocks, really their goal and their purpose is not looking to try to grow so much. Really what they want to do is they just want to create and drive as much revenue and do as much business as possible. They're not necessarily looking to grow their business and scale and get bigger and bigger. I mean, sure, they would love that, but most of the time that is just simply not the case. So they're looking for creating as many different type of income sources as possible, generating as much income as they can for the business. And then in order to draw in new investors, they offer out a dividend to investors who are purchasing shares of their stock. And you're going to receive the dividend based on every single share that you purchase or that you invest in their, in their dividend stock or in their business. So that is exactly what you can expect if you invest into a dividend stock. Expect that you are going to be investing into a company that is going to be a more mature company. You cannot expect, exponential growth out of investing into a dividend stock. Maybe you could go ahead and find a really good dividend stock. If you do a lot of research and find it, you might find one that is slightly outperforming the market and then still also pays a very small dividend. But that's going to be like a very rare occasion. And then even at some point, that company's going to hit the tipping point where they're not really growing or outperforming the market anymore. And then what they'll do is that growth is going to slow down, and then the dividend will come up because that's the only way that they're going to be able to attract new investors. So again, if you're someone who's looking to grow and build your wealth, and that is your primary focus, you're like, hey, I don't got a lot of wealth, but I need to be focusing on trying to grow and build my wealth, I would say growth stocks is probably the way to go because you are in the phase just like those businesses, you need to grow it. You need to, the same way they need to grow their business, you need to grow and build your wealth so that way you can reach financial freedom. Now, on the flip side, if you're someone who's like, hey man, I already got like a fairly sizable amount of wealth, you know, I'm pretty close to my financial freedom, or I am already there at my financial freedom, your primary goal is not necessarily, hey, I need to keep growing this thing, you know, faster and faster and faster. Really, what you're looking to do at this point is preserve your wealth, and you want to start to be able to enjoy your wealth while still growing it, but very slowly, you know, because you're not looking to take a lot of risk with your financial freedom and all this wealth that you have generated and built over the years. So for you, investing into something like a dividend stock or a handful of dividend stocks could be a really great way for you to take the wealth that you have built, invest into dividend stocks, and then start earning income now on all the wealth that you've built, most likely through investing into growth stocks in the earlier years or some other type of assets. And now you've taken that wealth and invested it into dividend stocks. So now you could start earning significant dividends paid out to you. Because another thing to keep in mind is if you haven't built really any wealth and you just start trying to, you know, invest into dividend stocks in the very beginning, it means your stock market portfolio is going to be growing very slow because these businesses that are dividend stocks, they grow very slow. And then unless you are investing very large amounts of money, the amount that you're going to be getting paid out in dividends is literally going to be pennies, possibly, you know, quarters. So how is that going to help you reach your financial freedom? It's really not. It's going to take far too much time, and you're going to grow very frustrated because your account is growing so slow. And it's going to feel like it's virtually impossible for you to reach your financial freedom. So again, like I said, the goal of this video is to really just inform you more about what growth stocks are and exactly what dividend stocks are, what to expect from both of them. And I hope I did exactly that in this video. Okay, so what's going to happen next is another video from my channel is going to pop up here on the screen. I want you to go ahead and click that video, and I will see you guys in that next video.